Who doesn't love a great magic trick? Well, let's talk some money magic and reveal the secret of homeownership and interest costs. I'm going to shatter the illusion of cash flow. So get ready. We're going to pull back the curtain and unlock this homeownership hack. So, why are so many homeowners hesitant to buy a new home today? They fear giving up that sweet interest rate on their current home. While rates may not be as high as they've been in the past, we've grown accustomed to rates in the 4 to 5% range over the last decade, and in recent years, even dropped into the twos and threes. Based on today's rates, approximately 92% of homeowners would face an increase in rate, with almost two-thirds currently enjoying rates below 4%. But let's dive into the history and to understanding how we got here. And to do that, we'll need to use magic. I'm just kidding. We're just going to examine some charts and understand how recent events have affected personal savings and credit card balances, leading to some really big economic disruption. The first thing you're going to notice on here is this massive spike in March of 22. I wonder what could have happened. Oh yes, COVID-19 and the government shutdown. It triggered some big changes in personal savings and the decline in credit card balances. How? With the government stimulus checks, people increased personal savings significantly and were able to reduce credit card debt, free money to pay off debt, and pad that savings account. But notice at the end of that COVID shutdown, now people are free to go out again, to go shopping, to travel, spending. And what we see is savings start to decline, and they're declining rapidly. It's this pent up energy like a prisoner on patrol, and we have all that extra money to burn. And Americans start to burn through it at a record pace. But fear not, the government can just print more money. And they did. We see two more spikes with small stimulus checks in January of 21 and a larger one in April. Americans are high rolling again. But we also see costs start to go up rapidly. The economics are simple. It's just supply and demand. Supply chain issues coupled with record high disposable income. What we get is too many dollars chasing too few goods equals inflation. The government has officially superheated the economy. Inflation starts to climb. And with inflation setting in, we see personal savings decrease further. Everything costs more and no more free money is magically appearing. What we see is once Americans get back to that normal savings rate, which is around 10%, credit card debt is at its lowest point. Then we get a shift. Americans, remember, they got used to being able to buy more stuff, to eat out again, to travel. Plus, everything is costing much more, and we've used up the free money. So, this causes a surge in credit card debt, which at the time had an average interest rate of about 14%. In response to spending concerns and inflation, the Fed begins rate hikes, and this was in March of 2022. And this leads to credit card rates and really just the cost of money going up quite a bit. Today, the average credit card rate has skyrocketed to 22% with record high balances. However, it's not just credit cards. Costs have increased in various areas like food, energy, and vehicles. The average car payment today is now $800. That is double what it was pre-COVID just 3 years ago. But on the bright side, inflation has also given us a big boost in our home equity. With all of this inflation, the average homeowner now has 231,000 in equity today and created massive wealth increase. But that sweet rate may not be the only interest cost in your household. Most credit card debt is a variable rate with higher balances and much higher costs. Blended rates could reveal the true cost of borrowed money. Even with a 3% interest rate on the home, the blended rate for the household could be much higher, impacting your overall financings. Rates are higher, people have debt. What can you do about it? Let's take a look at an example real quick. So imagine a person buying a new home facing a much higher interest rate compared with their current home rate. Let's say it's going from 3% to 6.75%. Having paid 500,000 for that home 6 years ago and putting 20% down, now it's worth 695, leaving them with significant equity. They have 343,000 remaining on the loan, and with the estimated cost to sell, they have about 317K in equity. If it costs around $12,000 in closing costs to buy the new home, that means they could put $305,000, taking it out of the current home and putting it into the purchase of a new home. Let's say they find their new dream home for $850,000. They plan to put down the full 305,000, resulting in a loan of 545,000. But here's where the shock comes in. The new home's payment is over $2,500 higher than the current payment. This is where most people decide, you know what, I'm good where I'm at. I'll just wait for rates to come down. But what if there's another way? So in our example, we're putting down the 305,000 or 36% of that $850,000 cost. Now that includes estimated property tax and insurance. More expensive home is going to have higher taxes and insurance. Nothing we can do about that. But let's look at all these debts with rates in the 20s. Most people are going to keep those to not lose that 3% home rate. But here comes the magic. By using some of that equity to pay off all of your interest debt, the cash flow difference could be surprisingly small. By revising the loan amount and using part of that equity to pay off high interest debt, the total cash flow difference in our example now is only $286 a month. This means the actual cost to get into that fancy new home could cost that costs over 350,000 more than the current home that you bought is now less than 300 a month. Plus, when rates drop, you can refinance and save even more. Here's something else to ponder though. By acting now, you could avoid the supply and demand frenzy that could really eat away at your equity. Waiting could actually cost you thousands, and let me explain. Rates move up and down with inflation, and inflation is starting to come down. So when rates do drop, let's say next year, which is what is expected, again, we're going to have this pent up demand for buyers and they're going to flood the market. Let's say you do wait. And if it's anything like 2020 and 2021, which a lot of economists think it's going to be worse, that pent up demand, and remember, everybody's been on the sidelines waiting for lower rates, it's likely to look like the start of a marathon race when rates do drop, which is going to push prices up and make it hard to win an offer for a home. In 2021 or 2020 and 2021, the fallout from that pent up demand from COVID shutdown was a frenzy of home buyers that we'd never seen before. And this was just a 3-month shutdown. We saw rates move up last year, and we're closing in on the 12-month mark of higher rates. There's people out there wanting to buy, so we think the demand is going to be worse this time when rates do drop. In 2020-21, it was typical to see 20 offers on a property in the first hours of a listing. Homes selling for above 650,000, it was really common for us to see those require a minimum of 100 over list price just to be in the conversation. And let's not forget that while waiting to buy a home, it's still appreciating and will likely cost more next year. For example, that $850,000 home in this example could easily cost $890,000 if they listed it next year. That's an additional $140,000 in cost just to hold on to that low rate. And in this example, you saved $286 a month. That's basically that's $3,432 a year. And if it takes 2 years for rates to come down, that's still less than $7,000. So if you are itching to buy a new home, let's just check the numbers for you. Get you your personal debt to dream home report. It's free, there's no obligation. Look, in the end, it may not make sense to buy now. So often, though, when it comes to finances, we miss how the trick works because we're looking in the wrong spot. We'll reveal the trick for you and see if this strategy that could make your debt disappear while letting you magically appear in your new dream home. Let us help you create a little money magic and get into that new home you want now. So give us a call. Let us know how we can help you best.